Hello, welcome to stocksposure.com. My name is Abhijit Mukherjee and I'm the Chief Strategist of Equities. I'm going to discuss in this video today what I mean by the SNAP framework. This is a simple guide to scanning for stocks. You've just seen the mention of the SNAP framework everywhere on our website, on social media. Today I'm going to elucidate on that. While there is a guide on the website of what the SNAP framework is, you will get a bit more clarity when I talk about it. Before we begin, however, I have to give you the standard disclaimer. All investments are subject to market risks and do your own research before investing. We are an educational initiative for retail traders, so we don't require SEBI registration. And therefore, whatever consequent illustrative examples we have used are purely for educational purposes. The simple foundation of the SNAP framework rests on the idea that if you become extremely discerning, extremely choosy, extremely picky on your stocks, the more likely that your entries and exits will be extremely systematic. When you're trying to pick a multi-bagger or when you're trying to make any form of an investment decision, the whole idea is that we don't want to get lucky ones. You don't want to get lucky. You want to do it in a professional manner, and it's something which should be repeatable. It has to be repeatable. It has to be repeatable. It has to be shareable, that you can talk about it to others. And then, of course, it has to be scalable, but that's not really the scope of today's discussion. In either case, you need to ensure that the first point I mentioned about it being repeatable, it remains, and you need to ensure that you become extremely choosy. How do you go ahead and do something like that? So the SNAP framework rests on simple ideas: sector, news, accumulation, and pattern. To be stronger to the index. If the index is moving up like this, the sectoral index you could check should outperform at any point of time. This is when you know that you're buying or you're looking at stocks from a particular bunch or a group that is going to do better than the average index. The whole idea when you're trying to individually buy names is that we want to outperform the index. If you're going to end up getting index like returns, it's much better to say buy a mutual fund or buy say an ETF, because you can outperform the index. You need to find, this is all our entire effort goes into finding sectors which are outperforming the index at any given point of time. If you're looking at any particular name within that sector, of course, the other stocks also need to be trending upwards. Just ensure that, because then you know that the entire bunch is doing well. So you got 5 different names all going up at the same time. So you know that big money is buying in one direction. There's initiative buying. Fundamentals, needless to say, have to be good. Now, in a sense, this is all connected, because if the fundamentals weren't good, perhaps the sector would not be good. But then there could be times that sectors are, bought securely on momentum and not really fundamentals have, much of a say in that. But if the fundamentals are pointing strongly towards the sector, so it just improves your odds. And the best part is if it gets picked up by analyst reports. Usually analysts are pretty late, but if analysts have been talking about it, if it's something that everybody's discussing, it really then it's like the cherry on top, because you know that there's volume, and see, prices can't move up if there isn't good volume. So that volume comes in when everybody's looking at the same thing. Moving on to the next particular aspect of this, we talk about the news. Well, what really is the news? If you found, say, some news report which has brought the stock into some form of focus? Is it something that, say, business channels have started covering? Is it something that, say, business papers have suddenly started focusing on? Is there anything which has brought the stock to the larger attention of the public? I don't know. It could be several sort of things, but when you open a newspaper and you're seeing, say, certain names every single day, it's worth checking them. A lot of times you don't have to go against the herd; you just go with the herd. So just ensure that you're always keeping tracks on what names are being discussed, and our entire approach, because we're looking at really buying momentum. Our entire approach is to look for stocks which are actually doing well or nearing their highs. Then, of course, is there any government policy that has been announced, or is there something in the pipeline that's positive, which could, give some form of headwinds for this particular name? Then earnings becomes very important. I think a lot of there's an entire phenomena called the price earnings announcement drift. So when earnings are announced, you usually, and positive ones at that, you usually have a gap up and a large bar, and then the stock starts drifting a little bit, and it can set up for a pretty good buy on that basis, and then has a continuation. So earnings called PED, this phenomenon, PED, that when you have earnings beaten estimates, usually means that it could be followed through, or has, say, profitability improved. Sometimes earnings might not have the same, but the balance sheet does clear up, or your income statements look a lot better than the previous quarters, or say anything miscellaneous in the form of, say, an M&A or new product development, R&D, or perhaps even pivot, closure of some business or getting to some new line. So any form of good news can seriously affect a stock. Of course, price factors in all of this, but once you've picked up your sector, any news which is positively influencing that stock becomes a point of interest for us. Then we, of course, move on to our third most important aspect on this is accumulation. And accumulation is simply price behavior. When I say that, we want to see a stock which has run up at least 30% in the preceding few weeks or few months. This is something which is very important. How we define that is basically a spike up. When you see a spike up, at any subsequent point of time, a pullback can theoretically become viable. If not, say, at the 50% level, at least the 30% odd level, you would get some form of an opportunity. Would you get follow through? That remains to be seen. But in any form of a pretty sustained price hike, which we define by, say, the number 30 odd percent. So 30% odd spike in, say, the preceding few months becomes a sign of accumulation for us, and we can end up basing. So basing is something, this entire base formation concept, which is very crucial for us in determining when an entry can become opportune. This entire price behavior structure, this is a sign of accumulation, because without volume, like I mentioned, without volume, this would not happen. So volume should be good when you're running up, and then it should sort of taper down when there's a bit of correction. This suggests that weak hands have started booking profits, but larger hands are the ones who are, again, buying back at lower prices because they're expecting some form of follow through eventually. And this entire structure, like I mentioned, has to be identifiable either in the form of a wedge or a flat base. This is what a wedge might look like. A flat base could look something like this. And a VCP could look something like this. or perhaps a rounding cup, a handle. In either of these cases, there is going to be follow through here because your risk is very small and the reward on strong follow through makes it an extremely high potential trade. Once you've of course done this and the sector news and accumulation has worked out, the final portion of our snap framework becomes price pattern. What exactly is the price pattern? Accumulation was price behavior that we mentioned, and price behavior in this particular form. But price pattern is nothing but a high probability technical buy setup that is formed either as, say, a bull bar, a J hook, or a pivot break. It's basically your risk level. If I had to just give you an example of what the price bar could have been like, this is a bull bar. You've got small bars here. Some of these might have a bit of a tail, some of these won't have a tail, and then suddenly you'll have one massive bar, voluminous. This becomes a good entry pattern. You know that you could keep a stop, say, somewhere below this. This would be a stop loss level. It could also be in the form of a J hook. What exactly is a J hook? You've got tiny bars which are correcting in an orderly fashion. It's nothing drastic. And then suddenly you have one bar, which is a green. And this is voluminous. So it's sort of that one bar taking out 2 or 3 bars. It looks like a J, or perhaps like a hook, if you see what's going on. So whenever you see this sort of a price pattern, you know that you formed a buy setup. And in this sort of a buy setup, your entry is quite clearly the close of this bar, and your stop loss is the base of this bar, or the base of this pattern, the swing point. Sometimes you could even say go for the pivot break. The pivot break could be something like this. If you don't have, say, a clear-cut bull bar, or if you don't have a well-formed J hook, buying above the pivot high, say the prior pivot high would be, say, something like this. So if you just blanket, you buy here, you place a limit order to buy, and you keep a stop, say, below this. This also does work at times, so long as this stop is not more than, say, 5 to 8%. In fact, if you look at either of these, the bull bar setup or the J hook, even here also, you're not going to find, say, more than 5 to 8% on the bar. This entire bar wouldn't be, say, more than 5 to 8%. If it is, one could theoretically buy it, but your best entry will come when you're not risking more than, say, 5 to 8% of the price of the stock on that particular position. So, like I've mentioned, this is behavior, accumulation, this is price pattern. Both are derivatives of price, but when we are combining that with at a level of when you first look at the sector and then the news on any particular stock in that sector, so you've narrowed it down. Good price behavior with an identifiable entry pattern gives rise to a trading decision. That, in a nutshell, is the SNAP framework. You take this framework, you go ahead and you apply it into all different sectors, and you'll eventually find setups. That is how we end up scanning for different names. And you could possibly take, say, the Nifty 500 as your addressable universe. And in those 500 stocks, you could perhaps break down sectors, and then within those sectors, you look at, say, the ones which are the hottest, and those hottest names would have eventually some of the other name which is forming something which is very, very identifiable. And in those, in terms of behavior, in those you could find the best technical setups. This gives you good risk reward, or shall I say reward to risk scenarios wherein measured bets can be taken. That's the Snap framework for you. And if you want to learn more about it, you of course have our website. You can open, say, the strategy section there. You'll get to read about this. And then, of course, there's the track record and great ideas that you can subscribe to. A lot of winning examples also have been shared. Choose your pricing plan and you'll get access to these features accordingly. I'd recommend going to the Pro, but it really doesn't matter initially because you're going to get free trials. So whatever you are comfortable with, go ahead, explore the website, subscribe to any of our plans, and you're definitely going to be better off in your trading and investing journey. With that, I'd bid adieu. Happy investing.